Let's connect then with Gautam Duggad as well, who's right here with us in our studios. Good to have you. We were just chatting with Atul Suri, who said that the target is not important, but the direction is. Are you going to give us a target or also just give us that?
No, as a house, we never have an index target.
No, so just give us a sense as to what you're making of the markets right now. The fact that we have managed to outperform, despite the fact that there's been FII selling. Where does India stand and what's the trend looking like?
Actually, FIIs have been buying this year, right? YTD, they've bought about $16-17 billion. Domestics have bought $14 billion. So YTD, you've seen CY23, $30 billion of inflows already. As far as setup is concerned, see, India is the only market right now where I think both macro and micro are firing in good combination, right? With about a 6.5% GDP growth, inflation having peaked out, rate hikes behind, currency by and large stable, and external balance also in fine fettle. And you add to that the 30% sort of growth that we saw in FY22, or rather 38. On top of that, you've seen 10% earnings growth in FY23. And this year we are building in about 20% growth, out of which first quarter itself was 32%. And we have seen an earnings upgrade. So remember one thing, I think last 3 years, markets have compounded 27%. I mean, Nifty earnings have compounded 23%. So in a slightly longer period of time, if you've seen, markets have broadly respected corporate earnings. FY10 to 20, when our earnings were lackluster, 6.5% compounding, markets gave you only 8.5% return. Last 3 years, 23% earnings compounding, markets compounded 27%. And this year we are talking about 20% kind of a returns. Yes, mid cap and small caps have rallied 28 to 30%. On a YTD basis for CY23. But if you see the compounding again for Nifty, while much is being made of 20,000 as a milestone, the 1 year, 5 year, 10 year CAGR for Nifty is just about 11 to 12%, which is nothing unusual. You know, this is the kind of nominal GDP growth you would have seen in the last 10 years. Even if you look at mid cap and small cap indices, still about June 23, the 5 year CAGR or a 6 year CAGR for mid cap was 12% and small cap was 6.5%. Last 3 months might have made it look slightly better than what it is. But yes, some pockets are overheated, no doubts about it. But to basically brush the entire market as overheated or sort of speculative, I wouldn't be in that school of thought.
So do you need that 50% 1 year before you peaks out? Because historically that has happened. 1999, 2000, you got a 50% Nifty or benchmark return, then it peaked out. 2007, I think, was a 30-40% return, then you peaked out. Do you need that one big explosive year, which could be a precursor to when markets will peak out? Because we've not had that explosive year at all.
Well, if wishes were horses, I would say it should never happen.
Of course.
Should keep getting about 15-20%. Look at it this way, Nikunj. This year, you've crossed 20,000. Nifty is up about 11-12% YTD. And two big components of the market, which is banks and financials and IT, together make up about 42% of the index weight, 27% bank, 14-15% IT. They haven't really contributed, especially the large cap private banks. And without two big chunks of the market not contributing, Nifty is already at 20,000. What if this two components starts contributing? Let me give you another historical data. 1999 till 2019, you've seen 5 Lok Sabha elections, 25 years.
1999
to 2019, 5 Lok Sabha elections.
Yes.
Every election, that is Lok Sabha election, 6 months prior to the announcement of election results. So election results are announced in May. Let's say 6 months prior to that, that is November to May period of this 5 different Lok Sabha elections era. Markets have given you positive returns, 10 to 32%.
Yeah.
Right?
The
best returns were in 1999 and 2009. Of course, every period has its own contextual nuances, but history is in favor of a pre-election rally, which is the period you will enter in another month and a half. And so far, if you go by the pre-poll surveys which have come in, last 15 days, we have seen about 3 pre-poll surveys. They are all pointing towards continuation of the current regime. If this sort of sentiment gets bolstered as you move closer to December, January, I foresee another leg of a rally, while everyone who's looking at things fundamentally, including me, will keep trying to make a sense of valuation versus growth versus fundamentals. But in the short term, 5-6 months, there is always a possibility that market disregards fundamentals and moves on something else, which is a big political event or a big macro event.
So if I put a flash out saying the Gautam Duggad, Motilal Oswal Securities of the view that we are entering a pre-election rally season for next 6 months.
Yeah, that's what historical evidence is. I mean, the data is there for everyone to see.
But what were the valuations like when these rallies have happened in the past? Because that is also important for us to put into context, right? So when these rallies have happened in the past, what were the starting points 6 months before the election and now?
So yes, valuations were very different at different points of time. Like 2009, if you see, it coincided with an era to October, November 2008 to May 2009. You remember we were coming out of that GFC.
Yes. The base was very different.
That time the valuations were very different. In fact, that's the only period where markets rallied 32% 6 months prior to the elections and 35% 6 months after the elections. Valuations were slightly expensive in 2014 period also. Because with the announcement of the current Prime Minister as a Prime Ministerial candidate for BJP in September 13, I think the market started taking a turn from September 2013. I think in their Goa national meeting they announced. Right? 2019, obviously, we were right there in the zone. That's why the pre-election rally was just 10-11%. Today, as we speak, we are at 19 times 1 year forward, which is about 5 to 6% discount to 10-year long period average. Right? So despite the rally, you're not trading in a very expensive zone as far as Nifty is concerned. So large caps are a very different kettle of fish. And large cap Nifty, if you look at the total market cap, is about 157 lakh crore or 157 trillion rupees. Mid cap index, which is roughly 43 trillion as of now as we speak, NSE mid cap 100, that index is trading at a 16-17% premium to Nifty as well as its own historical averages.
So in dollar terms, and Anisha, just to have a follow-up question on this, let's say India's market cap right now is about $4 trillion, broadly.
3.5, 3.6,
3.75, about one time GDP ratio, right? So let's say 3.75. How much of this market cap is right now trading below the average and how much of the market cap is above the average?
So if you look at it this way, I mean, for a very simplicity purpose, just use Nifty 50 as a benchmark for your large caps. And I said Nifty is in line with its long period average, maybe 4 or 5% lower than long period average. And Nifty is roughly 60% of India's market cap. Right? You add another 5-6% because there are a lot of large companies that are not part of the Nifty, which are recent listing of last 2-3 years. So I would still say 65% of the total market cap is still either in line or slightly below long period average.
That's a great point. Market sasta hai.
Secondly, a lot of times we keep getting carried away because 20,000 is a new level and a big milestone. That market is at a new high, market is at a new high. We've never seen headlines which says corporate profits are at a new high.
But that they'll always keep on making high, no?
Similarly, markets will also follow that corporate profit, right? We never say GDP is at a new high. The everyday media doesn't write a headline that corporate profits today are at a new high. But because markets are tracked on a daily basis, that gets highlighted. Your Nifty profits 3 years back were 3.5 lakh crore, FY20. FY23 was 6.4.
Wow.
This year we are talking about 7.8 and FY25 8.7. Our own coverage universe, Motilal Oswal coverage universe of roughly 260 stocks, it will cross a profit pool of 10 trillion rupees in FY24. It was 8.4 trillion last year. So, we are talking about a very different scale of profits, Nikunj, today. The profit that Nifty made in FY20 will be made by just 11 financial companies in FY25. 3.5 lakh crore Nifty 50 made. FY25, 11 financial companies in Nifty will make a profit of 3 lakh crores.
Yeah, I mean, HDFC Bank after combined entity next 2 years is projected to cross 150-160 lakh crore combined entity. So that's the kind of, we looked at Tata Steel numbers in the morning. So there is a lot happening. Yeah, why don't you take over?
No, I just had a follow-up. Now, since you're saying that, the returns on Nifty follow the corporate profits and you're talking about how next couple of years is going to be very solid with respect to profitability, are you saying the next couple of years we are likely to see high teen kind of returns and not just the average return of around 13-14% at index?
Ideally, it should be, because if the current trend sustains, which is that Nifty follows the corporate profitability, and if you're talking about 20% growth this year and about 15-16% growth next year, then ideally Nifty should give you similar returns, even if you don't assume any derating or re-rating, right? You just assume normalized circumstances, current PE sustains. Or look at it differently. Our EPS estimate for FY25 is 1140 rupees, right? Today you're talking about 20 times FY24 or 21 times FY24, which is 6 months later. If you were to extend a similar multiple 1 year down the line to FY25, so 1140 is the EPS, you apply a multiple of 20 times to that, you reach a number of somewhere about 22,800. Keep a margin of safety of 5-6% on EPS going wrong or numbers not meeting expectations. You're still talking about 20,200 to 23,000 kind of a range. If this 1140 EPS is delivered and current P multiples of somewhere about 20 sustains.
So you don't give a house view in terms of levels, but we have derived some levels from
It's
you.
a very logical, mathematical
That's just the
derivation.
inference of what data is telling you. But let's get a bit sector specific and stock specific now. So which sectors do you think will lead this rally? And I ask you that because there is a very disparate view, either be with the momentum and by the sectors which have done well, or be in the under-owned sector or the sectors which haven't done well. Which way are you going?
So look at it this way, different sectors have contributed if you look at last 5 years. Sectors which were pariah 3 years back, metals, oil and gas, they've come back strongly in 2021 and 2022. Then pharma took a breather for 2 years. It made a huge comeback in the last 6 months. Now, which are the sectors which are taking breather? Your Nifty is at a new high. All large cap IT companies are down anywhere between 20 to 25% from their respective 2021 highs. Their valuations are very reasonable. You look at large cap banks, they've hardly participated. Whereas the profit pool of the BFSI companies which I mentioned has gone up 5 times in 5 years. 45,000 crores in FY18 to 2,12,000 crores in FY23. This year we are talking about a 2.5 lakh crore profit pool. Companies which were trading at 3.5-4 time price to book are now available at 2.5, 2.6. So these are two big sectors which I mentioned at the beginning also, which has not participated. Whereas sectors like industrials, capex, manufacturing, PLI, defense, all that bracket, if you look at their combined market cap, and I was doing this exercise a month back, if you look at the top 1,000 market cap companies of India, sort them out in descending order, you filter out these companies belonging to industrials complex. There are 103 companies. Their combined market cap in July 2020 was 7 lakh crores. Today that market cap is 23 lakh crores. Wow. And if you keep aside the top 10 companies there, the likes of L&T, NTPCs, the rest of the companies, which is below $3 billion market cap, they are up anywhere between 6, 15, 20x. Right? So a sector which for 10 years had not seen cycle, the last capex cycle you saw was in 2012. And every year people used to write report, including us, that this is a year of private capex, this is a year of private capex. It never used to happen. Suddenly it has happened in last 1.5 years, and it is obliterated the entire underperformance of previous decade. You look at their 5-year CAGR, 10-year CAGR returns now. Their 10-year CAGR returns are now 19-20%. So that is what 1.5 year of a cycle is done. And we are still at the beginning of that cycle. The order books are still building up. Execution is still building up, whether it is road, railways, defense. You hear it every day in your news stories. So I think there are 4 or 5 sectors which are together having a coordinated upcycle. And after many, many years, capex we just spoke about. You look at real estate. The upcycle is happening after 10 years. You look at hotels. The 2008 EBITDA of Indian hotels and 2018 EBITDA was same. Average EBITDA margin of 15%. They did 35% EBITDA margin in 2023. Right?
Very high.
Auto, I mentioned to you about banks' profitability going up 5x in 5 years. In that same 5-year period, auto profits were flat. 30,000 crores, 30,000 crores. We are expecting it to double in next 2 years. So auto is the 4th sector where upcycle is happening out of 5 years. And last but not the least is hospitals, where I don't remember when was the last time there was an upcycle, because we didn't have too many hospital companies listed. So there are 4 or 5 sectors where you're seeing an upcycle after a very long time, and all of them are domestic cyclicals with good tailwinds behind them. Right? And there are not big contributors to the index, real estate, hotel, auto, all of them put together may not be even 10% of the index today. But they have a long growth runway ahead of them.
Okay. Fundamentally, forget what will happen today, tomorrow. How would you analyze railways and defense as cycles? One is this entire big picture. Second is the companies and how they will gain, and third is valuation. So fundamentally, I'm sure everybody is trying to understand from you that what is the right way to understand the railway business and defense as a sector.
So Nikunj, you have to look at business and stock prices separately in this sector because the stock prices have behaved very differently in the last 2 years. There can be a period of time where businesses scale up, execute, deliver returns, profitability, return ratios, everything. But stock prices may languish now. They will just flatten out, possibly for a period of a year or two. And I don't know when it will begin.
Both for railways and defense.
It is. Yeah.
You don't expect a fall. You don't expect a crack.
So that is a function of two things. One, how's this big macro election event plays out? Because all of these sectors, one of the biggest tailwinds behind them is the government policy momentum.
Yeah.
Right. If that sustains, then I don't expect a big crack. Okay. Stocks which have gone off 4x, 5x, a lot of these rail PSUs have gone off 4, 5x. So for them to correct 20, 30%, I won't call it as a crack. It can happen in a blink of an eye. You saw last week, one fine day, they fell 10, 15%. But a big crack is a function of two things. One is if the policy momentum disrupts in any way, irrespective of what is happening to their business, if there is a policy change, then the PE multiples can crash.
Okay.
Because they're end of the day government entities. Their working capital balance sheets are very different because their biggest customer is government. Second, if for whatever reason the execution suffers, a lot of things have to fall in place for execution to materialize. So even if the policy momentum is supportive, but execution is not supportive and execution falls apart, then there is a possibility of a crack. Otherwise, if you see some disappointment here or there on a quarterly numbers, you expected 100, they delivered 80 or 85, then, it is par for the course. Sometimes they will correct. Those who have felt left behind, they will jump in. But looks like the kind of numbers that we are talking about, and we had the advantage of Sudhanshu Mani, who is considered as the father of Vande Bharat Express, present at our conference last month. He was a key main track CEO track speaker. And he gave a lot of data points, how government is thinking, what kind of numbers they're talking about, kind of order books can be built, which all kind of different companies in different segments can benefit. So I think the path is very clear, just that you have to negotiate this big event, which is happening 6 months down the line.
So I'll summarize our interaction today and just interrupt me if you think I'm not able to summarize it well. You're of the view that markets may be at an all-time high, valuations or not. The tailwind in the sector, in the big sectors, is good enough to ensure that a CAGR double-digit return next couple of years cannot be ruled out. There are big themes like capex, real estate, hotels, autos, hospitals, which are the new driving things. And if one is looking at one large profit pool, the delta will come in automobiles and it will come in private banks.
Yes.
Have I missed on anything?
Just one thing I wanted to re-emphasize. Within financials, the kind of change or delta that you are seeing in PSU banks' profitability is unforeseen.
Okay.
Right. Together, they made a 30,000 crore loss in FY18. In FY23, they made a profit of 1,10,000 crores.
Yes.
All the PSU banks that you're talking about, we are right now looking at 16 to 18% ROE. I don't remember when was the last time they delivered this kind of an
I met
ROE.
SBI chairman. You know what return on equity number he told me? I was surprised when he told me that they're north of 20%. SBI is equivalent, it's not equivalent to HDFC Bank, but HDFC Bank is 23, 24%.
17%.
SBI is north of 20.
Possible, quite possible, because...
And he says I can build on it.
Yeah.
I'll send you the link of that interview in case you missed it. But he was bullish, he was confident, and he was charged up.
It's the single largest active overweight in our model portfolio. Our single largest overweight sector is PSU Bank for last 2 years now.
Have a look at the interview. Overweight could be double overweight after that. Really appreciate your time. Thank you for dropping to the studio. First time actually I'm interacting in the studio. So we must make this as an habit.
Sure.